Clade Investment Management was established in 2004. The aim to offer a comprehensive range of alternative, traditional, long-only and hybrid investment solutions for investors in Africa and globally. Joining me in studio is Stefano Marani, who is Director at Clade Investment Management. With me still, of course, is Ashraf Mohammed from Sycamore Fund. Stefano, you have, by your own admission, overperformed. Tell us by how much and how this is based on your investment approach.
Thank you. Yes, since inception, which was a little over 3.5 years ago, we've outperformed the All Z 40 by about 53% in absolute terms, which is approximately about 11.5% per annum, which compared to the All Z 40 over the same time period has probably done around 1.5%. So I think we're ahead of the curve and we're doing quite nicely. Year to date, we're up over 7%. And I think All Z is relatively flat, so I think the performance speaks for itself. We've done nicely.
The word algorithmic came up in our pre-interview discussion. I think that's a word that Ashraf wants to talk about.
Yeah, Stefano, could you explain the investment process behind the algorithms, exactly what the thinking was behind it when you set up?
Sure. It was a very, very simple concept. I mean, just thinking about the old adage, keep it simple. We didn't want to try and overcomplicate it with trends or anything like that. All that we look for is we look for a company's ability to generate cash flow from operations, because we believe cash is king. So what we do is that we've got a core portfolio. We weight that by the absolute cash flow from operations that the company is capable of generating, 1 to 40. And then the rest of the portfolio, we use futures to hedge out any kind of market movements.
So your universe is effectively the All Z 40. You don't trade outside of that.
It's close to the All Z 40. So we choose the top 50 or 60 by liquidity and market cap, but we only choose the top 40 with regards to cash flow from ops. So when it comes to the last 2 or 3 at the bottom, that's generally different from the All Z 40. 90% of the portfolio is the same as the All Z 40. But what we found from doing this, we have generated just from that selection alone over 330 basis points per annum of alpha above the All Z 40. And that's without trading.
Now, cash flow doesn't always translate into dividends. It doesn't always translate into a better share price.
No, not at all. But what it does translate to is defensive stocks that are profitable. So you're not buying the story. You're buying the truth. And
so what do you do? I mean, if it's so simple and you sort of set it and let it run, do you come in the morning, check for messages and go to lunch? I mean, what do you actually have to do?
No.
What in other words, when things happen in the market, you do sometimes have to think about your
look, finding returns, it's a little bit like the rabbit on the hole. It's there, but you've got to look to find him. So, like I said, we've got the core portfolio, which is the holding, and that is the incumbent portfolio that stays. We rebalance that every 6 or so months. We know that that's going to generate alpha every year for us, about 3% or so. Then what we spend the rest of the time doing is hedging the market move itself. So what we'll do is that we'll go long and short All Z futures on a regular basis, depending on what we think is happening from a market's perspective, specifically with regards to what's happening in the world right now. I mean, if you look at the European situation, it's really not healthy. Our best case scenario right now is that the market just ends up being range bound. That's the best case scenario. Worst case scenario, we see another correction of some quite significant proportions.
So you obviously make trend calls, be it market moving higher or lower, and you then go long or short the All Z along with your long positions.
Correct.
In terms of your top 10 or 15 holdings.
So where's the scope for the big mistakes? It's gone well. What kind of conditions would make you more uncertain?
I think we always err more towards the side of caution than bravado. So I think our biggest mistake that we could make is underperforming the market because our portfolio is too conservative. It played well into our favor in 2008. I think where the rest of the market came off about 50-60%, we had a positive return that year. So we are very, very quick to get ourselves into a cash situation.
Particular stocks that have done well for you on this basis?
All right, so What that methodology has translated to in right now, if you look at our top holdings, we've got Billiton, we've got Anglo, Sab Miller, we've got Sasol.
That's 4 big global diversified companies.
If you think all commodity based. So these are the companies in South Africa that are generating the largest profits on a cash basis. So what that means relative to our portfolio is that we think we are particularly well positioned over the next several years, because if you look at the mining industry in South Africa, it has not done as well as the rest of the market. It's underperformed. Its PEs are significantly lower than the rest of the market average. Yet we've still managed to generate this alpha. So I believe that we're very well positioned right now when these mining stocks start to come back
Okay,
online.
let me ask this question, because now bugs me. Yes, they're generating a lot of cash, and price movements in certain areas are fairly strong. Do you look at the cash flow per share relative to price as one of your key ratios?
No.
So
We've kept it very, very
so
simple.
it's just the absolute cash number.
We did an inordinate amount of research, and you can. Some other people use the RAFI. We believe that our methodology is superior. Obviously, I'm slightly biased there, so.
You would say that, yeah.
But we've looked at a number of different methodologies, and it doesn't matter which way you cut it. And there's more than enough research out there. Cash flow from operations is always the best weighting to use. It always generates more returns.
I recall interviewing Brian Joffe, and he's got this massive, his head office is about the size of the studio, and he's got 115,000 employees worldwide. Now, how does he keep in touch with them all? And one of the things he said was, I asked for a daily cash flow report. So what you're saying is cash flow is underestimated as a factor.
Our motto, cash is king. Cash is king.
When do you sit down and review this? Is it constant, or are there times when you actually have to say, look, guys, we've got to review this?
No, right now we're saying that a lot, especially when you start to hear catchphrases on the news. Take profit. There's a lot of taking profit right now.
We've seen a lot in the last week.
Enormous, which is why the markets are off as much as they are. The other thing that is really starting to get me nervous is the VIX. So for the viewers, the VIX is the arithmetic average of the implied volatilities on options on the S&P exchange.
It's quite a lot to think about there.
It is a lot to think about, but what that means is it's a very good indicator of nervousness about the market. Now, the VIX, up until 2 weeks ago, reached levels that were unseen since 2007. That is a telltale sign that the market has been too bullish. Point in case, markets globally, we've seen about mid-20% returns since August last year. That's huge. Yeah.
We'll have to stop there just as we're getting going, and quite technical, but still nonetheless very fascinating.